Hey everyone, welcome back to Corporate Decoder. Today we're diving into the Howard Hughes Corporation's latest quarterly report, and let me tell you, it's less about glamorous skyscrapers and more about, well, we'll get to that smirky real estate stuff soon enough. In this episode, we're dissecting their financial health, looking at their big bets, and trying to figure out if this corporation is building castles in the sky or just laying a solid foundation. If you're into getting the real story behind corporate reports, hit that subscribe button. We also have a Discord community linked in the description below if you want to discuss about investing with other viewers. First up, this is a Form 10Q filing, meaning it's a quarterly report giving investors a snapshot of how the company performed over the last 3 months, in this case ending on March of 2025. These are essentially check-ins to make sure the company is doing what it says it's doing. Let's get to the numbers. Howard Hughes Corporation's assets are sitting at about $9.3 billion. That sounds like a lot, and it is, but it's only a tiny increase from the end of last year, which was $9.2 billion. We need to dig in and understand why they're not making better increases, but first, their accounts receivable, the money owed to them, is up to $125 million from $105 to $5.2 million at the end of last year. So more people owe them money and they are more efficient at collecting that debt. Here's an interesting point. The number of shares outstanding hasn't changed. It's stuck at 10 shares, and those shares are 100% owned by Howard Hughes Holdings, Inc. That means the company is completely owned by the parent, which is unusual since public companies tend to have millions of shares spread across different investors. Now let's peek at the table of contents to see what kind of financial fund we're in for. We've got all the usual things: the balance sheets, income statements, cash flow statements, and then of course the notes. The notes are where the juicy details hide. Okay, let's set the stage with their accounting practices. They're following what's generally accepted in the United States, so that's pretty standard. There is mention of Seaport Entertainment spin-off, which is important. It affected their profits. Since the company sold or got rid of its entertainment business, Seaport, the numbers from that aren't included in the regular ongoing parts of the financial statements. This makes it easier to see how the core real estate business is doing. Their net loss from discontinued operations was $31.5 million. As you can see, the report has made sure we know which numbers are being discarded from calculations and which ones aren't. They're also involved in partnerships and ventures, but don't control them directly. These are accounted for using something called the equity method. These joint ventures have debts of their own. In terms of legal problems, there's a legal issue in Columbia, Maryland, and another in Tiburon Park, Texas. They don't think these will cost them a lot, but you never know. The company is holding a lot of debt. Total debt is over $5.2 billion. Most of this debt is secured with real estate, and the interest rates vary. It is a lot of leverage. The values of their assets and debt seem fair based on market values. To protect themselves from changes in interest rates, they use financial tools like interest rate swaps and caps. It gets complicated quickly, but think of it as insurance. They made about $200 million in revenue. A big part of this came from land sales in their master planned communities and rental income from their properties. Looking at where the money is coming from, condo sales contributed only a tiny amount. Most of it comes from land sales in their master planned communities. They still have a ton of work to do on existing deals. The total value of all these future obligations is over $3 billion. They lease some of their land or buildings. They have to pay on those leases, and that cost is around $5 million. They also make money by renting out their retail spaces and offices. They have 3 main areas, also called segments: operating assets, master planned communities, and strategic developments. Let's break down those segments. First is operating assets segment. It is the section that owns and runs existing properties like shopping centers and office buildings. The section EBT, earnings before tax, is usually high with stable real estate companies. Their revenues from that area are $114 million. Second, the master planned communities segment is all about planning and selling land in big community developments. It has higher variance since it depends on land sales, with its revenue reported at around $84.5 million. The strategic development segment consists of mostly residential and commercial developments. Usually they have a tiny revenue and huge costs, which in this case their cost is $3.5 million in the red. Alright, there's some stuff that happened after the quarter ended that are also pretty important. Pershing Square transaction. Basically, HHH sold a chunk of its shares for a whopping $900 million. They're planning to use that money to buy up stakes in other companies and grow beyond just real estate. This transaction and the related agreements are described in more detail in HH's current report on Form 8K filed with the SEC on May 6, 2025. Bridgeland Mud Sale, they sold the rights to get money from some of their municipal utility districts for $180 million. As did Canal. What does all this mean? Howard Hughes Corporation is undergoing some significant changes. They're sitting on a good chunk of assets and they're making money from selling land and renting out properties. Their move to bring in $900 million from Pershing Square really shows that it is about to change its business directions and invest into new fields. It's a bold move but could be risky. Real estate and holding diverse set of companies are two very different kind of businesses. That will bring some changes and require to have new expertise. The additional Bridgeland sales that they are doing is pretty smart. It would free up a lot of capital and make them efficient. As overall, the Howard Hughes Corporation is at a turning point. Keep an eye on how they handle this shift in strategy because it could make or break their future. Alright, that was our deep dive into the Howard Hughes Corporation's latest financial adventures. What did you think? Are they making smart moves or are they heading for trouble? Let's discuss it in the comments. And if this analysis helped you, hit that like button and subscribe for more corporate decoding. Also check our Discord channel, the link is down below.